Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On April 18th and 19th, Fidelity Investments Canada hosted Focus 2024, a two-day event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. Today, we'll hear portfolio manager Salim Hart's focus session, sitting down for discussion on stage with host Glen Davidson. Salim is known to Canadian investors as co-portfolio manager on Fidelity Global Intrinsic Value, working alongside Sam Chamovitz and Morgen Peck. And today, in addition to speaking with Glen about the team's approach to global intrinsic value, he'll also share the strategy behind a new fund, Fidelity Global Micro-Cap Fund, launched on May 22nd. Because of how often microcap companies may be overlooked, the microcap universe represents one of the least efficient asset classes available to investors. At Fidelity, there is no rock too small, and today's microcaps could become the large caps of the future. So there's significant upside potential to getting in on the ground floor. Over to Salim and Glen to tell us more. This podcast was recorded on April 18th, 2024.
Welcome, Salim. It's great to have you up here.
Yeah, that was a nice introduction. I appreciated that.
So now everybody knows that you are launching a new strategy, and we'll get into that in a minute. But what they don't know is that you just traveled all the way to Austin to see the eclipse.
It was a little cloudy.
It was
but,
cloudy?
We had a few breaks. Unlike I heard in Toronto, you did not. But we had a few breaks. We had the telescope out. I got a few pictures through the telescope. It was fun.
Okay, we're going to see those now. No, we're not. I'm glad that worked out for you. And we are going to talk about the microcap strategy, but not yet. Let's talk about what you've currently been doing, what everybody knows you as being doing as far as getting on stage with Joel in the past and with Sam and Morgen. So how do you work with Sam and Morgen?
Yeah, so Global Intrinsic Value is a fund that is based in, as everyone knows who's familiar with the product, very cheap stocks, high quality business models, good management teams, and companies we think we can own for a very long time, assuming they don't get overvalued or we misinterpret their fundamentals. So you've heard I've been working with Joel a long time. He retired at the end of last year. It's been a very, very smooth transition. I think maybe the smoothest we could have ever hoped for. Turnover on the fund has remained low. If you look at the stats, it's been very style consistent. I think Morgen and Sam are great stock pickers. They have been groomed for many years, as you might have imagined, as our star fundamental stock pickers in a investment philosophy similar to Joel. So they come in on the fundamental side. I continue to manage everything quantitatively. So I like to think about them as they're picking the ingredients, and I'm kind of putting it all together, doing the day-to-day work, creating the really sweet product and packaging it up for everyone. So I do everything from portfolio construction to sizing positions. I manage the day-to-day flows. I also screen for new ideas for them to include in the funds. I monitor the existing positions. My quantitative models that I built with Joel many years ago crunch about 2 million data points per day. So we have a broad focus on everything going on in the portfolios. Many years ago, when I first joined the small cap team in Boston, our boss, our chief investment officer, called me Robo Joel in jest. But I thought, that's probably pretty good for my career. And it did turn out to be that way. So I'm happy to be here. We're working great as a team. The transition's gone smoothly, and we're very excited about the fund going forward.
It sounds like it couldn't have gone smoother.
I would agree.
Very well. So you've kept the same processes as far as being a quant on that team.
Yes.
Which has worked very well.
I think it provides a really nice, smooth transition to have somebody that's kind of been stable on the portfolio since 2015 doing the same thing, and they're now coming in and really bringing their brilliant stock picking. Changing the portfolio a little bit in terms of some of the names, but sticking with many, many names and keeping the style very consistent.
Now, Joel's not gone.
Correct.
He's there. He's consulting. Do you see him often? How's he doing?
Yeah, he comes in the office a couple times a week. I still talk to him regularly. Actually, a couple weeks ago, we had a happy hour where we all went and played ping pong at a new place.
Happy hour playing ping pong.
They give you a bucket of balls, and then they have people like going around mopping up the ping pong balls, so you don't have to retrieve your ball, which is a great way to teach Joel how to play ping pong, because there were like balls going everywhere. It was pretty crazy, but definitely talking to him about a lot of the work we're doing on the new microcap fund, on some of the ways we're trying to harness the fundamental research by using artificial intelligence and large language models, which he was super excited about. So yeah, definitely he wants to mentor on this fund and be involved. And he's like, yeah, give me the list of stocks. I want to see them. And he's going to give me some new ideas.
Wow.
We're always talking. And also, I mean, our boss made a joke during the transition. He's like, it's probably really difficult for you guys to have your biggest shareholder sitting in the office right next to you, looking at your trades every day and making comments on them. And he was right.
Makes you a bit nervous, I'm sure.
I mean, yeah, definitely Joel is opinionated.
You're a quant. You're a self-proclaimed quant.
Correct.
Fundamental, but you've learned things from him. How have you adapted and how have you learned from him?
Yeah, I mean, he's a contrarian, a value investor. We're both super frugal and cheap, so we get along in terms of like clipping coupons and not owning cars and taking public transportation, all the fun stories I've told in the past. But I mean, I think he's been a really good mentor in terms of being able to make your own way, stand up for what you believe in, you grain against the market and do the opposite of what everybody else is doing. And also, I think what will help on the new microcap fund is just how to trade a lot of these illiquid stocks. Be patient, use limit orders, ideally just sit back and let the market come to you. So, Fidelity gets a lot of calls from brokers trying to move big blocks of stock, and they'll say, we have this, $20 million for sale of this really small company. And sometimes we'll say, hey, we'll buy it at a 5% discount. And, half the time they'll be like, all right, hit that. So we don't necessarily have to pay up for liquidity. If we're smart about it, we can actually kind of wait and let the liquidity come to us, which is something I've learned from him. And also just working with our global trading desks in London and Hong Kong and in Boston.
Well, I'm glad you have the opportunity to continue learning from him. Let's talk, before we get into global microcap, let's talk about your thoughts on the market and where you think we're at right now, and then we'll get into what this new fund is all about.
Yeah, so I think the market has come back from, let's say, a year and a half ago when I think the general market consensus a year and a half ago was along the lines of soft landing, high rates, and it had gone down and valuations had come back down to a somewhat reasonable level. And I think that was kind of our base case too. But everyone was completely wrong, obviously. We've had, they weren't wrong about the high rates, but they were wrong about the soft landing, at least so far, right? So now what people have been discounting maybe until the last few weeks when rates have gone up was a lot lower rates with many Fed rate cuts this year, along with very strong growth and good earnings. So basically they've gone to a somewhat pessimistic view on the markets, the general consensus, to a quite optimistic view. And I think investors just have to think about what's priced in right now and kind of take the over under or the odds on that. Not a whole lot can get better in terms of low rates, high growth, and robust profits, right? That's kind of the nirvana for the stock market. So maybe that can last, but the odds are probably it can't get much better than that. So I think the flip side, maybe the worst thing for the markets would be high and persistent inflation, not coming down as fast, which is what we're seeing. Rates higher for a lot longer, combined with a Fed that's forced to slow down the economy significantly in order to combat those rates. And I think you're starting to see that narrative creep back in just in the last few weeks a little bit, like maybe that will have to happen. But I think if you get high persistent rates with high inflation and much weaker earnings growth and economic growth, that would be kind of the worst case for the market. So I just think people have to kind of weigh that as a possibility and not totally discount it, even though it's not a base case.
Good stuff. So congratulations on this fund launching.
Thank you.
Gone into pre-launch. It's launching, I think, as Alex said, on May the 22nd.
Fidelity Canada was the first really to launch the global intrinsic value strategy when we did it in 2015, right? Like there were Joel products. We had low price in the US for a long time, but this was the truly first Joel only unconstrained go anywhere portfolio that ever existed. Since then, we've launched one in Japan a few years ago. And I don't know if you know, but last month we launched one in Europe for European investors. So based on the success of GIV, it's now offered everywhere in the world, basically. And you guys were at the forefront of it. And again, with microcaps.
So you're foreshadowing
not many people are willing to launch a microcap fund, one, at all, and two, at a time when they're very, very much out of favor. This is a great time to get in microcaps. They've been underperforming and they're very cheap.
Wow, you're really excited about this.
Can you tell?
Should I be frightened about the fact that it's called Global Micro-Cap?
We've done some work internally that says microcaps aren't really much more volatile than small caps in general. So individually, if you were to hold a very large position in one of these micro-cap stocks, it would be quite volatile. But the really nice part of a portfolio is we can construct it to be well diversified and to hold a large number of stocks. So overall as a portfolio, it's actually not that risky because we diversify away a lot of the stock-specific risks. Similar to how I've talked about global intrinsic value, when you take a lot of really small companies that are cheap and pretty high-quality businesses and you put them together, what you get is this, what looks like a very cheap, high-quality conglomerate that's actually pretty low vol in general. And we've seen that in GIV, right, with the 11%
how many holdings
Alex mentioned, you know.
How many holdings do you expect to have, or have you had in the pilot that you expect to do?
I mean, I think we'd expect somewhere between 500 to 800 plus or minus a couple hundred. The large range.
But that's what we're used to through Joel. And
Absolutely.
We're also used to
it's going to be a very flat portfolio. Yeah. There's not going to be huge positions, and it's going to be all over the world. And if you were to think about the range that we invest in, our universe is going to be down to about 50 million, and I'm thinking US dollar market cap because I'm from Boston, but 50 million USD on the small side up to maybe the $3 billion range on the upside. So it's kind of like all the micro caps plus the bottom half of the small cap index, which I think is a place that not a lot of small cap portfolio managers play in as much, the smaller small cap. So that's kind of how we're thinking about our investable universe.
But it also makes sense based on the technology that you use and the expertise that you have that we can entertain that many names in a portfolio. We should address that right now is what resources do you have to crunch through all the variables to create a portfolio the size of what you're talking about?
Where do I start? So there's so many things I could talk about in that question. So one, let me talk about risk and portfolio construction, and then I'll talk about stock picking opportunity set, and then I'll talk about how the Fidelity fundamental research comes into it. Okay? It's going to be a long answer.
Okay.
Stop me if you get bored.
I'll just get comfortable.
Okay. So on the risk side, I have developed through Global Intrinsic Value as well as other products that I run, a proprietary risk framework that basically looks at the correlations, the covariances of all the stocks that we own, not only to all the stocks to each other, but also to every stock in the world. So basically I have a really good assessment, and quantitative techniques are extremely good at portfolio construction, understanding how stocks move relative to each other into the markets. Okay, so I'll give you a great example, which I love to talk about. You guys might know Whole Foods. They have some in Canada. Mm-hmm. So I'm thinking back to before Whole Foods got bought by Amazon. I was creating this risk model to use in the funds prior to Global Intrinsic Value. And I said, which stocks are most similar to Whole Foods? Like, how do you think about risk? Because Whole Foods is a high-end grocery store for those who don't know it. Traditionally, especially before Amazon bought it, it was very high-priced foods. It's often called whole paycheck. But it was very like truffles and high-end olives and things, specialty foods, right? You can't get anywhere else. So if you put it through a traditional risk model like Barra is like the most popular commercial risk model out there, Barra will say Whole Foods is very similar to Kroger, Safeway, and Walmart because it's a staples retailer. They sell a lot of food. So it's in an industry group that's correlated to those stocks. But it's actually not the case. When I put it through my risk model, I saw Whole Foods was most correlated to Lululemon, to Ulta salons, to Starbucks, and to Michael Kors. Completely different set of stocks, consumer discretionary stocks. And I was like, this makes total sense. When I walk through Whole Foods, I see the people in their tights carrying their Michael Kors handbags, wearing their Ulta makeup with their lattes in their hands, right? It's the same clients that we're dealing with here. And by looking at how the stocks move rather than just what they're selling, and that's my risk framework. So I guess what I'm saying, long story short, is I feel like I've developed a really unique risk framework from a quantitative perspective that takes that into account and can form a portfolio that's a lot less volatile and a lot more safe for people and a bit smoother ride. So that's on the risk side. There's a lot of opportunities in microcap. So kind of on the alpha side, the dispersion of returns, if you think about large caps, maybe a really good stock will go up 70% or down 30%, right? That's kind of the range for a large cap, US stock, for example. Micro caps, the best stock might be up 1,000% or more and down 100%. There's a lot of dispersion in returns each year. And if you can go in and you really need active management to harness that. And a lot of it's just about avoiding the losers. But there's just a lot more opportunity to find the winners. And because this is a global fund, we just have such a large universe of 7,000 to 8,000 stocks to choose from. Even if we're just looking at what we think is the best 10% of those, 700 or 800 stocks is actually still a pretty small number. So there's lots of ability for us to stock pick in this universe, in a universe that really not many other people are looking at, and they don't want to be in because it's really hard to trade and takes a lot of time. I'm going to be up a lot of late nights. And then on your last
Sorry,
point,
just to jump onto that, they're not looking at it because they don't have the infrastructure to do it.
Yeah, and just, it's often not worth people's time. It's like, how much time am I going to spend on this 50 million cap company? I can't really establish a big position size. A lot of portfolio managers are concentrated, so you can't really get a concentrated portfolio manager investing in this space. You kind of have to take the time and have the resources to evaluate a large number of stocks. And that's where also fundamental research comes in. This is a kind of combination quant and fundamental research product, research process. And this is actually what I'm most excited about. There were 3 things that needed to happen to make this fund viable. I can give you the backstory if you want later, but we needed capacity. We needed a way to have and harness our fundamental research. And we needed a way to make this not too volatile and a safer product for people to invest in.
Sounds good.
Right. And it's taken years to get that right, but I actually feel like we've gotten it there, and the management in Canada and the management in the US finally agrees it's the right time to do it. So we got all that lined up. And what we really have now, I think, was kind of the final step we needed, is a way to harness all the fundamental research. So if I can explain how the fundamental research process works, most research analysts at Fidelity are given a list of stocks. So they cover these stocks, assign ratings to them, write notes on them every month, every quarter, basically cover them very closely. But we also have opportunistic coverage. So there's also analysts, in addition to their formal coverage, but also most of our small cap analysts can go and look for ideas anywhere, and they publish notes on them. So they might go to a conference, they might call up the company, talk to the management, and they'll write a short note about it and put it in the system. But there's no formal rating or way to say, was this a good company or not, until today, or actually maybe until a couple months ago when we finished this project. But what I've done, and I've worked on a project with our data scientists, we've read over 500,000 Fidelity research notes over the last 20 years using large language models. We use both Llama 2, which is the Meta, the Facebook.
Sorry, I know everybody knows what a large language model is.
ChatGPT, do you know ChatGPT? Okay, so GPT-4 is one of them, Llama 2. Basically, they do a really good job understanding language. So you can say, I'm going to read you the prompt. I brought it with me. This is what we fed into GPT-4. We said, you are a friendly AI assistant with expert financial knowledge who follows instructions extremely well. As a side note, you have to say that because they like to misbehave, apparently. Help as much as you can. Remember, be accurate and truthful, and don't make up any answers. If you don't know the answers, just say so. Read this company research note. For example, here's a company research note that we feed in. And on a scale of 1 to 100, how would you rate its sentiment and long-term outlook? So what we can do is basically take 500,000 research notes, and over the course of a few weeks, read them all, rank them all, score them all, and it'll even spit out like 3 bullets for each one, says this is why I liked it or didn't like it. It's amazing. I've done a sample subset where I read a couple dozen and kind of compared it to the large language model ratings, and it was really good. The old way that quants used to do this is we'd create a dictionary of these are positive words and these are negative.
Yeah.
Like beneficiary might be a positive word or loser might be a negative word, right? And you basically do a word count, like how many positive words, how many negative words. And that works okay. These are kind of life-changing. So, I mean, I know, the investment case is there, the stocks have run up. We're not investing in it, but we're using it really effectively. So every morning at 1 a.m., kicks off, it takes about 2 minutes, it reads all the research notes from yesterday.
2 minutes.
For 1 day's worth of notes. Yeah. It's super quick. And I asked Joel when we were playing ping pong, I was like, Joel, do you think you could, so what we get about like half of our universe. If we go back a few years and look at like what's actually covered, half our universe in microcaps is covered. It's amazing. So we get good fundamental coverage. And I said, Joel, do you think you could read like 3,500 research notes in a month to prepare for this launch? And
right.
Like, no, I can't. I don't think so. This is really great. I want to see the output. So he was excited as well. And I think I'm excited about it because it's kind of that final like nail in the coffin on yes, we can do this.
Wow.
We can harness these hundreds of thousands of research notes that we've written over the years as an input and get really good coverage in the microcap space. One, I don't think any other firms are doing this, and two, I don't think they have the research coverage to be able to do it on, even if they could build
Or the technology.
the infrastructure to do it.
Right.
I don't think they'd have the material because it's all proprietary research.
So there's people in this room and there's people watching that would remember in the early 90s, Brad Lewis ran Growth America and for a little while Small Cap America, and he used neural networks. And he used to talk about computers that none of us had the access to get personally, but he was way ahead of everybody, and he would crunch all the stuff at night and it would come out with recommendations in the morning. That was then. This sounds like a modern day version of that sort of expertise that other firms couldn't.
4.0, yeah, this is good stuff.
You're pretty excited about that stuff.
Yeah, I think it'll really help find really great stocks everywhere in the world that are off everybody's radar that we've talked to and looked at, but we're not going to formally cover because it really isn't worth an analyst's time to be like covering it every quarter and doing quarterly reporting on it. But if they say, hey, this is a great management team, this might be worth an investment, like that's something we can harness and use in this fund.
Will you overlay your thoughts on geography, or will you go with whatever the results give you as far as the geographical allocation?
What we've always done is sector geography allocations are just a result of the bottoms up process. So I'm not making any calls on this is a great place, but it's just where we're finding great stocks. In global intrinsic value, it's been Japan and internationally, more so than the US. The new the small cap benchmark for global intrinsic value is about 60% US. The micro cap benchmark is actually only about 33% US. So this will be a much more internationally focused portfolio, just based on the universe that's out there.
Okay, so you've alleviated my concern, my fear about the word because of diversity through the number of selections, the expertise of the research notes that we pile through all of this. It's also able to be quite active as far as what would the frequency of trading be potentially?
We like to take a long-term time horizon with our style, right? It's going to be similar style, cheap stocks, high quality names, ideally good management teams when we can find them, although they're fewer and further between in the microcap space. But it's stocks that we can hold for the long run because they are expensive to trade, Glenn. I mean, there's no question about it, right? Like, you're not just getting in and out of these every day. This is a buy and hold strategy, and when we find an opportunity, we make those pair trades, but it's not a churn and burn type thing.
Okay, help us understand this. It's a micro-cap fund, so you buy a very small capitalization company,
Yes.
with the hope that it becomes a large capitalization company at some point, of which you have examples from Global Intrinsic Value. But at what point do they have to be booted out of the portfolio so that it maintains its status as a global micro-cap fund?
So I'll give you an example. When we launched Global Intrinsic Value in 2015, it's a company called Deckers. You may have heard of it. They make UGG boots, they make Teva sandals, Hoka sneakers is one of their newer products that have been really popular. I mean, they're just amazing at kind of innovating and introducing products and getting the hype built up around them, right? So we bought it when it was still maybe not quite a microcap, but small. It was like $2 billion, and now it's $22 billion. Okay, so, and through the end of last year, we made 10 times our money. But it's an example of what we are hoping to achieve with all the stocks in the microcap fund, what I'm hoping to achieve. It won't happen to all of them, but if you ever see a 22 billion cap company in the microcap fund, you're looking through the holdings and you're saying, this is ridiculous. He owns a 20 billion cap company. I'm not buying anything above my threshold of 3 whatever billion it is, right? It has to be under that. If you see that, it means the stock's gone up 5, 10 times, and that's what we want. And as long as it's still somewhat reasonably priced, still a good company, and we still like the fundamental outlook, we'll hold it forever.
Good. So
and that's Joel's strategy.
Okay.
Right? That's something I learned from Joel. Like, don't sell your winners short, right? I mean, he buys things and holds them for 20 years, and that would be the hope that we can do that with some of the stocks in this portfolio.
And of course, his fund was low-price stock fund, which had a threshold, but he was allowed
bottom low, but he could hold them forever, and he liked to do that. So
okay,
won't be all of them, it won't be the majority of them, but a few. I'm hoping we can see some multi-billion stocks in there eventually over the years.
if a number of them stay as microcap for quite a while, is there a capacity constraint on this fund?
That's a good question. One of the conditions I mentioned to launching it, that obviously Fidelity Management it's important for them to be able to launch a fund with sufficient capacity so everybody who wants to get in can get in the fund. But I do think that, unlike most of our funds, we'll probably have to close it at a slightly lower level. Mm-hmm. It's a wide range right now, but based on the numbers I've run and the simulations I've run, we're thinking $1.5 to $3 billion range is the capacity. Could be plus or minus. We don't exactly know yet. Partially, it'll depend on how quickly the flows, how quickly or slowly it builds to those levels. If it's just a little bit of a trickle every day in terms of flows, that's easy. It can be a little bigger. So it partly depends on the timing and speed of flows, but we are going to close it once we reach a point where we feel like existing shareholders are not being helped or are being hurt by the trading or the flows. So that's kind of the capacity. And Fidelity's always been very supportive of portfolio managers making that call on when to do that.
I think that's an interesting point. It's not about a marketing angle. It's about, is it impacting returns?
Yeah, it's not about marketing. It's about being able to manage the fund effectively for existing shareholders, definitely.
So launching May 22nd, what thematic opportunities are within it that you can talk to us about?
Japan has been working really well for us. We've been overweight there a long time, and it's finally getting some attention. Not only the corporate governance, which is starting to thaw a little bit, where management teams are returning money. You're seeing a few more activists. But the market's still the cheapest developed market out there. It finally, after 30 plus years, hit a new record high. And so breaking out technically, for people who like technicals, that's an important factor. But then you also have the tailwinds of really the easiest and most liquid monetary policy in the world. Rates are still very, very low there. The central bank's still, buying their JGBs like crazy. The weak yen, I don't know if you've seen it, it's like 154, and that's a tailwind for their companies because many of them are exporting. So the weak yen really helps them. So I think the combination of that, the corporate governance, the return of capital, the weak yen, and the loose monetary policy, lots of really cash-rich, high quality in terms of their businesses, not necessarily their management teams and their shareholder friendliness, but hopefully that's changing.
And he's been a fan of Japan for a long time. Traveled
absolutely. I mean, it hasn't helped us until recently, but we've been overweight Japan since we launched GIV in 2015. So we're patient though. We're patient value investors. We'll wait. And eventually, the value will be recognized.
The office that you're in at 245 Summer has so many meetings, thousands of meetings every year.
We have a whole floor. The top floor is dedicated to company meetings. Yeah.
And that's not your thing. You're digesting all of this research. But will you ever go, I'm going to go up to the 13th or 14th floor, and I'm going to attend some meetings just to add to the expertise that you're developing?
Probably never. I did it once, and I was like, never again. But what I will do, and I did last year, I went to visit our London office. And I talked to all the analysts there and also had some really great discussions with our traders on liquidity, on currency. I'm currently planning to go to our Hong Kong and Tokyo offices this year in the summer. So I talk to the analysts. I tell them what we need for the portfolio. They tell me what their new ideas are. Meeting with the traders on the trading desk is key in a product like this. Yeah. So I think that's the thing I'm doing more of, is building relationships, sourcing ideas, talking to experts on how do we get the liquidity we want at a cheap price. So I guess it's more on the internal management, and I leave the fundamental analysis to our great team of analysts. There's nothing I can really add to that, but I think what I've always done is been able to take that, quantify it, and synthesize it with quantitative portfolio construction and quantitative stock picking models that I built, for Joel and the Persist. So I think that's where my real strength is.
Are you the example for the rest of Fidelity on this mandate, or is there already something existing with Fidelity globally
For microcap?
Yeah.
You mean? No, not that I don't think
so. You're pioneering all that you're doing.
I don't think we have one anywhere in the world. I don't think we've had a microcap.
And why do you think that is?
I think they've always been worried about capacity and can it be a real viable standalone product. I launched a microcap pilot internally 10 years ago because I was really excited about it, working with Joel, just seeing the opportunity for stock picking there is kind of massive. I think it's taken the ability to integrate the fundamental research, get good coverage, but also design a product that can have capacity. And I think I've done that based on how I'm sizing positions, the lower turnover, which makes trading costs lower, and the number of positions and the geographic scope, right? One of the pushbacks I got when I was saying we need to do this year is people don't want global, at least in the US for whatever reason, because they're so like US focused. Right. And they said, we want US. I said, no, we need a global product because that's where we get capacity. Mm-hmm. So a lot of it's been designing an appropriate product that will have the capacity for people to invest in, right? That's always been the constraint. And I think we've finally done that.
Capacity and risk mitigation too.
Exactly, yes. Mm.
And can you briefly tell us, I'm sure there's a long answer for it, but briefly tell us about the creation of a pilot. How does that all come together? And then you said you ran it for 10 years, so it's not available. It's with Fidelity's money.
Correct.
And then the decision is made to launch. How does it get started? And then how is the decision made to launch?
I mean, Fidelity's always open to new ideas and thinking about what kind of things to launch. I'd been on the small cap team for about 4 or 5 years at that point. I was working closely with Joel. And really the thought process was, we didn't really know what the use of this or what the use case would be for this internal kind of pilot fund, but let's try it out and see what happens. So originally one of the thoughts was a lot of the small cap portfolio managers tend to invest up cap, even in small caps. Like they tend to be a little larger than their benchmark or toward the top half. Like maybe we could use this as a complement portfolio for them to balance their portfolios out and have some micro cap exposure, right? Like that was one of the ideas. We weren't really sure what it would be, but we thought, let's test it out and see what the stock picking ability here is by combining quant and our fundamental research. At that point, we weren't using the large language models. We were using just kind of the ratings and the covered stocks. So there's more opportunities here. But the real kind of proof, and I think some of the product team in Canada really liked this, where we looked at microcaps go bankrupt a lot, right? They're small companies. Some of them are levered. We estimated over like 20 years, we looked at how many went down more than 75%. So we're kind of saying those are the zeros. And about, 6 to 7% of the universe of the microcap stocks were busts every year. But in the pilot fund, only about 2% were busts. So I think we've proven that we have the ability to kind of wade through all the junk out there and separate the quality a bit and have a stock picking process that will avoid a lot of the really big losers and get the better ones. So I guess the short story is it was kind of a proof of concept in terms of validate.
And that concept is not static. It's going to continue to evolve.
Absolutely, yeah.
Tweaks, I'm sure, daily.
It's just getting better, I think.
Okay, does this exist in Canada with any other firm that you know?
You'd have to tell me. I don't know.
I don't think so. No.
At least saying no.
So
that's awesome.
I
actually didn't know that. I mean, there are some microcap funds in the U.S. I don't think they're going to be nearly as good as this, but there are some. So that's interesting that this doesn't really exist in Canada. That's great.
Well, that's good news for you.
Yeah, that's good.
And some may try after, but they won't be what you're doing.
Well, bring it on.
To get the number of research reports on microcap means that we must cover everything. Fidelity must cover every stock. I mean,
what needs to happen is when an analyst goes to a conference and meets with 20, 30 companies, they need to write a research note that says, this was my takeaway, right? And by capturing that, that's where the value is in these microcap stocks, right? They're not going to pick up every stock, but at least they get a research note in the system, and now we have a process to incorporate that and get their views on it. That's the key, really.
Well, and they know it's useful, because now they can go down cap, and they know that someone like yourself is excited about it. And it could potentially be available in global markets as well.
Yes. Yes.
Very interesting. Okay, so this is a core holding, or is this a peripheral holding for clients? Why don't you talk to us about where you see this fitting from what you've learned so far and where it may fit with a client's portfolio?
So looking at Global Intrinsic Value, the fund that's been around since 2015, I've always said that can serve as a core equity holding. It's well diversified across geography, sector, market cap. It's go anywhere. So whatever the percent is, it can be like a big holding for somewhat risk-averse investors who like a very stable ride and good returns and low volatility, right? You heard the story on that. it can be I'd be comfortable with it being over half of someone's portfolio. Maybe you supplement it with a little growth if you're so inclined, and maybe some Canadian stocks to get more home country exposure.
That's global intrinsic value.
Right, exactly. Taking a step back to the micro-cap fund, I like to think of global intrinsic value as the tortoise, and there's plenty of funds that I'm not going to name, but you can think of that are the hare, if you know the tortoise and the hare. The tortoise, really slow pace, but kind of wins by not losing and just staying the course. The hares are all over the place. Sometimes they're up, sometimes they're down. Mm-hmm. I'm thinking of the micro-cap fund as like a alligator. It can have a lot of bite, but they're not that fast. They're actually kind of boring most of the time and just plodding along, right? Like, I bet you could outrun an alligator.
Well, I don't want to try.
But if you don't, there's a lot of bite. So there's some bite there, right? It's almost like a liquid alt space to some extent. We've talked about that. So what I think is it shouldn't be half your portfolio, right? It shouldn't be like your core equity holding. So while global intrinsic value can be a core holding for some people, I actually feel like microcap should be a small holding for everyone, because hardly anyone has exposure to this space. It's very unique. It's uncorrelated. And how else are you going to get microcap exposure? It's not like you're probably not going out and buying these really small companies that you've never heard of, right?
Excellent. We've got to wrap. That was very interesting.
When I come back, I have a lot more to talk about.
Oh, yeah. You can come back, right? I don't know if we can fit you in tomorrow, but we'll see.
All right.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.